results. Bruce Flatt is the CEO of Brookfield, a global investment firm with more than $1 trillion. That's with the T, folks, of assets under management, AUM, as at last count. He joins us live here at the SGX. Bruce, great to see you. Welcome.
Morning. Thanks for having me.
No, it's our pleasure. So listen, a lot to talk to you about, right? About how you're navigating tariffs and what's happening geopolitically. But first, though, let's sort of ease into this and get you to talk to us a little bit more about Brookfield itself. I mentioned that AUM, over $1 trillion. That puts you up there with Berkshire. Yet, when most folks think about or talk about Brookfield, you know, it's sort of low profile, under the radar, right? You don't hear as much about Brookfield as you do, let's say, Apollo, KKR, or Carlyle. Why is that? Is that a conscious decision?
You know, we just try to do our business, and we've tried for a long time to just do a great job for our clients, invest around the world. We invest in the backbone of the global economy, and generally the businesses we own give you your water in the morning. They give you your electricity in the afternoon, and you drive on a road, and you don't know who we are.
These are all things we take for granted.
Yeah, you take them for granted, and we just earn a small coupon on the way. We lever it a little bit, and we deliver our clients a very long-term historical return, and the returns have been outstanding for a long period of time.
So let's talk about that, right? And this is pretty under the radar. And Connie, let's bring up a couple of charts if we could. You took over Brookfield 2002, correct? So you've been at the helm for probably more than 25 years now?
Seems like a long time.
And if you compare that same time frame with what's happened to at Berkshire Hathaway under the Oracle of Omaha, and I guess we could call you the Oracle of, I don't know, Winnipeg or something, right? Take a look at this, guys. The stock performance. I mean, your investors ought to be pretty happy with you.
You know, we've compounded returns for 18% for 30 years, annualized.
Yeah.
Not many have done that. And it's just, the simple thing is, and we learned this from Mr. Buffett, if you can compound at 10% plus over a very long period of time, great long-term wealth can be created.
Yeah.
And that's all we're trying to do in our client funds for our clients that we create different funds.
Yeah.
And for the overall business, we've just tried to not make too many big mistakes.
Yeah.
Make little ones because you need to grow. But just continue to compound wealth over long periods of time and not get wrapped up in the short-term iterations of the market.
Yeah.
And that's really, I'd say, what the success has been for a long period of time.
Okay, and you know, your business model, you started yourself with the company's own money. You brought in institutional investors, and the new leg, and this has been going on for probably 5-6 years already, right, with Howard Marks and Oaktree, right? You're starting to channel that out to retail investors, right, but ultra high net worth individuals, of course, right? You've got three REITs right now, but private REITs.
So our the business, as you noted, started investing our own money. We then started with institutional clients. Today, there's 2 other avenues of growth that are going to, I'd say, propel us and propel private markets. And that's the insurance money that we've brought into the business to continue to put our alternative products into insurance companies. Because for long-term compounding, of course, these type of assets are ideal to be in insurance accounts. And then secondly, and we're just at the early stages of this, for retail clients, for individuals, these are the perfect things. Just like an institutional client, what you should want in your retirement account is something that's going to compound away at 10% for the next 25 years. Nice. When you retire 25 years from now, it will be worth a lot more, and you'll be able to cash it out and do something with that capital and live on it. And we're just in the early stages of tailoring our products to be able to put them into accounts and have retail individuals own them. Okay. And so we, with our Oaktree franchise, we have a number of credit products in our infrastructure business. We have an infrastructure product. We have a real estate product, and those are. But we're just in the early stages of it. Yeah. It's de minimis percentages in retail. And it will probably get to 50% like institutional accounts 20 years from today. The same thing that happened for the last 20 years in institutional. When we started going to institutional clients, we tried to get them to buy alternatives at the time. Today, they're 50% in many accounts, and that's what's going to happen in retail.
Initially, it was kind of a hard sell, right?
It was
but
impossible.
anyway, look. Your AUM at trillion. I've heard you talking about how over a reasonable period of time you intend to double that, correct, to 2 trillion. By when is that?
In the next 5-7 years. The numbers, when they get larger, they compound to bigger numbers. That's the thing about compound wealth.
Yeah.
And but what we've found over time is there are many businesses where if you grow, success sometimes doesn't go with it. But in the things that we buy and build and own, these businesses get better as you get bigger. And when you buy something for $100 million, you get a management team that is this big and this qualified. And when you buy a $5 billion business, you get a better one. You buy a $50 billion business, it's better than that. And just the quality of businesses you get, we find are that much better. And there's just not that much competition that can do the size of transactions that we did. We just bought a pipeline business in the United States the other day. It's a $9 billion transaction. There's just not many people that can put out $9 billion the same week as the tariffs came out. And that just, those two things just differentiate our money. Yeah. Therefore, our returns can earn outsized returns. And
so you mentioned tariffs, so let's get into that, right? I mean, it's a pretty chaotic time for the world and for investors as well. I've heard you and read you talk about tariffs, and you've kind of brushed them aside. You've been saying that, look, we're invested in infrastructure. It's not trade per se, right? But you are invested into things like container ports, right? So that's goods, that's containers, ships, and movement. So I mean, you must have been sort of affected, right?
When you have $1 trillion of things, nothing ever goes. Everything goes well, and nothing ever goes totally bad. You're diversified, and so there's no doubt. There's some of the things that we do are affected by tariff, but by and large, what we do is we go to countries, we invest in those countries, we sell goods or products to companies or individuals, and they stay in that country. So by and large, and many of our things are regulated rate base or contractual in nature, and inflation is actually a positive to the numbers. So as inflation comes in, it actually helps the revenue streams of those businesses.
Okay, so inflation is one thing. I've heard you talking about interest rates as well overnight, and this is on the back of, this is fallout from that Moody's downgrade on U.S. sovereign debt to AA1 now, right? We have the long bond hit about 5%. Interest rates are probably a little bit more important to you than inflation, correct?
Yes, although private markets, if you trade fixed income, interest rates and daily movements are really important. Yeah. Private market assets borrow money on the treasury rate and the spread. Yeah. And when treasury rates go down, spreads go out. And the all-in coupon comes in. We're not far off what all-in coupons were in 2022 for private markets because the spreads widen out. So we were borrowing then at 5%, today we're borrowing at 6%. And the returns that we earn in private markets, in general, are much, much higher than that. So yes, it's better to have 200 basis points less on your interest rate, but it doesn't really matter in the fullness of time.
Okay, let's talk about inflation then. And you've also talked about how inflation is something that you're not too concerned about as well because it's a rising tide that sort of lifts all boats, right? Let's take property, for example, where you started your career, right? You have inflation, values and prices of property go up, rentals go up as well. It's all really good because you can charge more rent until you can't. Isn't there sort of a tipping point?
Yeah, I think the interesting thing about real estate specifically is that there is no supply being built in most places in the world today because of COVID and then because of inflationary and interest rate issues. Yeah. So we've had 5 years of undersupply, and the situation of supply-demand is now getting acute and getting into a problem. And therefore, rents are going up across the world. And yes, that's causing more inflation, but it is good for real estate owners. So we've far past the bottom of the market in real estate, and fundamentals are coming back globally.
Okay. All right. Talk to us about infrastructure, which is your thing, right? When folks think about infrastructure in Asia, they always talk about this infrastructure deficit, which is so big that no government or governments on their own can even hope to get close to meeting or fulfilling, right? Which brings in the role and the need for private capital, right? But in the past, when we've talked about these PPPs, public-private partnerships, it's always been a hard sell for private money simply because they're looking at it going, well, I don't know if I can get a decent rate of return. How have you been able to do that?
So sometimes we deal with governments in transactions on PPPs, but by and large, our business has been with corporations. So we've been funding global businesses to meet their capital needs. And today, what that's really driven at is the digitalization of everything going on in the world. What's behind this computer and your phone in the morning that you operate with, and everything in your life has gone onto that and increasingly will go onto that. Yeah. What you have to imagine is everything behind it. It's the fiber to get to the tower, to transmit it across the city, to go to the data center. Yeah. And all of those things, including now the build out of artificial intelligence within the data center. And these data centers are increasing in size. Size used to be 50 megawatts per data center. Yeah. Today it's 1,000. And this is $50 billion of total investment per data center. Yeah. And that is what's really exciting going on right now in the build out of infrastructure. And these are all with private businesses. This is with the great technology businesses in the world, and we're really facilitating the operating skills to get these things built. Okay. And the capital to provide them to do it.
Fantastic. And I know you're also building a power plant and also a fab for folks like Intel. So listen, Bruce, I really wish we had more time, but it's been so good talking to you, though.
Martin, thanks for having me.
No, it's been a pleasure. Come back, see us again very soon.
Thank you.
All right.